Made good money this year? Cool. The IRS wants its cut.
Did you plan for it? Most people don't.
That's why they get crushed.
We're two accountants who've seen it all, and we're breaking it down so it doesn't happen to you.
Two accountants talking shit. Let's go, Gary. Welcome back to a Two Accountants Talking Shit podcast. Today we're going to talk about NIL for young athletes, collegiate athletes, and the tax implications. So I'm Mike.
I'm Gary.
And this is Two Accountants Talking Shit.
All right, what does NIL stand for those who don't know it?
I forgot.
Name, image, likeness.
I knew that. Name, image, likeness. For years, collegiate athletes were not paid. They were considered amateur athletes, and it was illegal for them to take money. People went to jail, for taking money.
Right. Yeah, boosters, people who are fans of the team would pay money to the athletes to get them to come to a certain school.
The most infamous was probably MSU. They got what was considered the death penalty, and it ruined their football program forever, for years.
Yeah.
But corruption and bribes have been going on in collegiate sports, especially football and basketball, for years.
Yeah.
And then recently, it became legal to pay collegiate athletes to come to their schools.
It was 2021, I believe.
We're going to talk about the tax implications because we're two accountants. Talk shit.
Hey,
we got it right that time.
That's it. We did it. All right. So, a lot of athletes, just like a lot of business owners, contractors, people that we've talked about in the past, a lot of them don't know that they are a business, right? So let's say we've got an athlete that gets a deal for $50,000 for appearing in a local commercial for a car dealership or something. That person may or may not know that they have to pay taxes on that money. I mean, hopefully they do, but a lot of them do not. And if they don't have a business set up, an LLC or some business entity, they're going to be paying taxes on that as a sole proprietor. And what's the bad thing about that? All of that income is going to be subject to self-employment tax.
How much is self-employment tax?
It's 15.3%. So it's Social Security and Medicare on top of whatever income tax they have to pay.
But more importantly, and this happens more and more often than you think, these young athletes, especially these young athletes, they don't realize that the taxes aren't getting withheld for them.
Right.
So they get a big tax surprise at the end of the year that they owe quite a bit of money.
Right.
Especially, it could be up to close to half, depending on what state they live in, for the taxes that were not withheld, meaning the employer or whoever gave them the money, the school or a booster, did not pay a certain percentage to the IRS on their behalf. So they are on the hook for that.
Yeah, it's really interesting because the collectives, they call them, of boosters. It's interesting because they have been traditionally, or at least many of them, setting up their organizations as nonprofits. So they will then contribute a charitable contribution of $20,000 or $50,000 to a nonprofit collective that then pays the athlete. So they're able to deduct the payment that they make to the collective, and then the collective pays the athlete, and then, theoretically the athlete should be paying tax on that. The collectives are being challenged now, obviously, but interesting that that's one approach that people have been taking to try to minimize their taxes as someone contributing money to the athletes.
As if the boosters contributing to the education and the institutions are nonprofits, and so they wouldn't have to report that income, taxable income either.
Yeah, a lot of times they'll present it as, we have a nonprofit motive. We just want this athlete to come make a speech or whatever. But really, it's for them to come join
promote the program.
Right. Exactly. What should college athletes do when they start to realize that they're going to earn some money through a program? What do you think they should do first?
What they should do first, if they don't have an advisor, they should get an advisor or talk to an accountant.
Yep.
And really try to understand the tax implications that they need to withhold and they need to pay, whether it's estimated taxes, they need to pay that quarterly.
Yep.
But they also should set up an entity that's one tax strategy, is setting up an entity so that they could avoid paying the self-employment tax and treat themselves as a business. They certainly look at themselves as a business. Name, image, and likeness suggests that they are promoting themselves as a business. I think that concept is understood.
Yeah.
But unlike an individual, a business pays taxes quarterly, estimated taxes through the individual, but really gets their final tax bill at the end of the year after they deduct all their expenses associated with that revenue that they've earned or they've gotten. and then they get their final tax bill.
That's a good point. Like any business, the athletes are able to write off expenses associated with whatever. If I was an athlete, like training, if I'm paying a trainer, I imagine they get a lot of that stuff for free. But whatever expenses they are incurring for that,
That's a really good point. I mean, to be a college athlete before NIL, it was it was very expensive.
Yeah.
I mean, they all have personal coaches, private coaches. Not all of them, but
right.
The top football players certainly do in basketball. And so now they're able to deduct those expenses.
Right. Yeah. And another interesting thing when I think about this is that a lot of the income is earned income. So that is subject to self-employment tax and just earned income taxes. But a lot of it's probably royalties. Let's say if you're featured on a video game, for example.
Taxed differently. Mm-hmm.
Yeah. So that's passive income. So that's taxed differently. And you would want to have a different tax strategy for that rather than if you're earning the income through appearances or something where you're actively doing something to generate that revenue.
So who are some of the higher paid?
Oh yeah.
See, if you notice, Gary usually has a laptop or notes. I don't.
You made fun of how big the laptop was.
It was
last
huge.
time. So I decided to print it this time.
I'm sorry to hurt your feelings.
It did not. It did not.
My intention was to embarrass you for how old you are.
Do you have any idea who the? And I don't know.
Probably Archie Manning.
Archie, you looked at this already.
I don't need to look at notes. Everyone knows. I mean, how much is he getting?
This says his estimated NIL value is between 6.5, 6.8 million. I mean, when you're looking at this stuff, it's interesting because they don't really know the total value of what these people get. I think in a lot of cases they're probably getting more than people know because a lot of it's probably not public.
So the NCAA and these institutions have been making so much money off college football and baskall.
Right.
I mean, just
for
think about the
and
NFL. If they didn't have to pay their players,
right,
how much money they would make.
Right.
So I've always kind of thought, when is the NCAA going to say, well, maybe your eligibility is more than just 4 or 5 years?
Yeah.
Because you make more money, the top players make more money in college than they do on a rookie contract in the NFL.
Right.
So where's the incentive to go to the NFL?
Right.
You stay in school for 18 years, kind of like you did.
I like school, man. Who do you think the highest? I actually knew this one without looking it up because everyone knows who she is. Who do you think the highest female paid athlete is?
Probably Caitlin Clark.
She was up there. She was. I don't know how much she made, but Livy Dunn, that gymnast from LSU. You don't know her?
I'm not from the South.
She's
Gary's from Georgia.
She's huge on social media. So she makes.
How much did Trump's granddaughter get? I bet you she got something.
I don't know. For NIL, she's an athlete.
Yeah, she plays golf.
Oh, I don't know. I'll have to look that up.
Too bad your laptop's not here.
Too fast. It's in my bag. I can pull it out.
How long have you had that laptop bag?
Oh man.
It's embarrassing, but at this point, it's a relic. Let me see it.
Can I see it? Okay.
Mm-hmm. For years since I've known you.
No, not since you've known me.
Okay, 20 years?
I probably got this laptop bag. Oh my gosh, it's heavy. I got this laptop bag in, it's warm, man.
It looks like you're making like an illegal drug drop. How much cash do you have in it?
No comment.
I bet we went through it right now. There'd be so many old, irrelevant things.
There probably would.
A few years back, I went through his wallet, and he had so many rewards cards that were expired.
Well, you never can tell when you're going to need something.
It was like this big.
Yeah.
Do you have a wallet now?
No, I got stolen last week.
Oh, that's right. And I didn't believe him. He got so mad at me because I just got pickpocketed. I'm like, no one pickpocketed you, man.
Yes, they did. All right.
So what was the item in your wallet that you were most upset about losing?
I had some cash in there, man.
What was the items?
Cash and a couple debit cards, credit cards. Yeah, that was it.
You're lying.
That's not true. All right, let's get back on track here. What else do people need to know about NIL and taxes?
I think this is more directed probably for the athletes.
Yeah.
The athletes need to know. If they're a business, the good news is you get to deduct a lot of these expenses that you traditionally weren't able to. That's the good news. But the bad news is you could get yourself into a conundrum with the IRS.
Well, it's just like
the states. In the states, the states are particularly, some states are very aggressive.
Yep.
And they go after the jock tax like we talked about last time.
Yeah, we talked about that a little bit last time. That's
and you have to pay certain state taxes depending on even if you don't live in that state.
Yeah,
If you perform or if you play in that state.
right. So if you live in Florida and play a bunch of games in California, you're gonna have to pay taxes on those games if you're
Because
earning.
California
If
is
that's part of
aggressive
what you're earning, right?
about going after that, and
Right.
there's no state income tax in Florida.
Right. Or if you're doing even an appearance, let's say you go do an appearance, and at that appearance you get paid a $70,000 speaking fee in New York. New York's going to want to get paid their income tax on that revenue, right?
Mm-hmm.
So
A buddy of mine, son that plays at a small college in Washington, baseball, and I'm like, what if I gave him some money as a way of it's not a gift tax, he needs money for school. I was going to help him anyway, but if I go through the NIL, I mean, he's a college athlete.
pay him to do an ad for us.
Yeah.
He can promote our podcast.
Mm-hmm.
I think he'd be embarrassed to do that.
Yes. So really, let's definitely do it.
I'll give you $5,000 if you promote it. Does he have a lot of followers on social media?
None.
No.
But what I'm saying is that could
Does he
it
have
be
more than
used as
us?
a way to launder money or
Well-
give money to your family?
Set up a collective and count it as a 501c3 and then take it as a charitable contribution. I'm just kidding. Don't do that. That's what people are getting in trouble for doing.
Uh-huh.
But you could pay him to advertise. We could pay him to advertise our podcast, and that would be, you'd be generating
Do
revenue.
you have to give a reason why you're paying them? Can it just be go to that school?
Yeah, probably.
Mm.
I mean, I think that's kind of what the collectors. I mean, I think they're structuring it as like we're giving speeches or we're making appearances, things like that.
Yeah, are there obligations associated with the money?
I think there usually are some obligations
Too
associated.
bad your
with it.
laptop's not here. We looked that up fast. Once this podcast blows up, we'll have someone in the booth.
Yeah, that's right.
Doing
That's
the
right.
research
We
for
need like a.
Hold on.
That's
Yeah, I know I'm carrying Gary.
right.
I come up with all the ideas.
Oh yeah. All
Yeah.
right. All right. All right.
So,
My job is to get you here,
it's difficult.
which is
I like
not,
Mondays.
not always easy. Yeah,
Yeah.
we're gonna start.
What
doing
happened
some
this
Mondays.
Monday? We had planned
it was-
to meet and to do this Monday, but you were tired.
Yeah.
What'd you do all weekend? You can tell the producer to edit this out too.
Yeah. No, because I'm not gonna say anything. I had a good weekend.
Mm-hmm.
Yeah, had a fun time.
Nice company.
Mm-hmm.
Mhm.
Yeah, that'll be a different podcast actually, or maybe a reality show.
Okay. So athletes could get in trouble.
Right.
You could be really excited about getting all this money and then realize there's a lot of strings attached. I think it's common sense. There's. Yeah.
I mean, it's not common sense if you're 18 or 19 years old and you're getting this money and you're like, yeah, I have some idea I got to pay taxes on it, but
But you want to make sure you're keeping good records and take as many deductions as possible, legitimate deductions that have something to do with, you're being an athlete. And there's quite a bit. I mean, these people, this is their life. They eat, sleep, breathe their particular sport. There's so much specialization now.
exactly. And if if you've never run a business before, like separating out your personal and business expenses, that's important.
That's what I'm saying. Like almost everything isn't personal. It's almost all sports related or career related.
So if they're, just like any small business owner that we talk to, the athletes should do the same thing. They should, if they end up setting up an LLC or something or some form of entity, then they should set up a bank account, credit card associated with that LLC, and just use that for every business expense. So it's separated out.
That makes sense. So another strategy would be multiple state tax returns.
Yeah.
Because if you live in Florida, no state income tax, you're gonna be required to pay in California, for example.
Right. If you live in
earning
California, income there. But see, that's the interesting part about it. It depends on how you would structure the money you're receiving, right? You're not getting paid to necessarily play a game in California. You're getting paid to advertise a product or make a speech so I think it's important how they structure this stuff.
Yeah, I was kind of going down that angle, but then I thought the states don't care. If they don't care where you earn it. There's certain states.
Oh yeah, yeah.
So if you live in California
No,
or
yeah.
Florida,
That's
I mean, California or New York, that's
Right.
all considered those states' income as well.
That's right.
No
Yeah.
matter
So
where
if
you
you
are.
lived in California and you played for, let's say, UCLA, and you went and did an appearance in Florida and didn't have to pay tax there, you're still gonna have to pay tax on that in California.
Mhm. So the multiple state tax returns really only affect those that don't live in a high tax state.
Well, that's not necessarily, because if, again, that situation, if I was playing at UCLA and then I went and did some appearance. I was sponsored by a company in New York.
Well, in New York, we're using the two extremes, but like Arizona, for example, Arizona's going to want their money, and so you would pay that state income tax, but then you get that as a deduction on your California or New
That's
York.
right. Yeah,
Yes.
the Arizona rate's 2.5%. So California is obviously much higher than that. So you would get basically a credit for what you paid to Arizona on your California tax return.
Would you have to pay that difference, the delta, to California?
Mm-hmm. Yeah.
Oh man,
Yep.
greedy.
That's why we're in business, man.
Yeah.
People got it gets complex. I mean, I've done tax returns where the people have 30 states. It gets complicated because some states give you credit for certain states and other ones don't. And you can get taxed twice by the same state in a multi-state tax situation.
Mm-hmm.
So yeah, it's definitely, if you have multiple states you're dealing with, you definitely need to talk to a tax professional about that because it gets super complicated.
We should develop a product just for these athletes that tracks their expenses, where they're at, their location, and the type of income that they're earning. So it's the different tax rates, different state tax rates, and to make sure that they get all the deductions that they're allowed to get. What expenses do they have that aren't legitimate deductions?
Yeah,
Their meals, their personal chef,
going to a trainer,
the trainer, the coaching,
the gym,
the equipment, home gym. I don't know. Can you see your home gym at your home?
Sure.
Yeah, absolutely. Sure. Okay, what wouldn't be deductible?
Like for example, the IRS has disallowed in the past in court cases a business person deducting their suit, for example. Like a person would say, "Well, my suit is part of my image at work. That should be deductible." But the IRS
is required,
right? Because it's personal, quote unquote. Right.
But a uniform is required.
Yeah.
But then I probably don't pay for that. What about hobby versus real business?
Yeah, the hobby versus real business is, I don't think it would apply here because really that only applies when you have multiple losses over several years.
What about?
Oh
no, this isn't. Why is everything gonna be bad?
I don't know. You got that grin like you're about to ask me something.
What
crazy.
about going 3 years back?
What do you mean?
Like you get money this year. What about all those expenses from previous years?
Well, it depends. Like, it depends.
Would that be considered a hobby?
Depending. Right. That's a good point because if the intent.
What if I bought a racehorse?
Yeah, I mean that's where the hobby loss rule started. But no, if your intent is to make money, that's when you can deduct your expenses. You don't have to even generate revenue. If you have a profit intent or profit motive, that's when you can start. And I'm outlaying cash to start generating that income. Then you can start deducting that whenever it happens. But like in the racehorse example, if I buy a horse and I never take it,
so if I'm in high school,
money.
I didn't want to talk about the horse. So if I'm in high school and I know I'm going to go to a college, or I might go to a college that's going to pay me money, I should set up an LLC right away and carry those losses forward.
Potentially. I mean, it really depends on your situation, because a lot of them they don't have a job in high school. And so
I'm saying the training, the equipment, all these like future investments in your business.
Yeah. Yeah. Depending on the situation, you actually, that would make sense.
Yeah.
I'm starting, I've opened my business, quote unquote.
Mm-hmm.
So I'm tracking
my expenses that are going to help me earn money in the future. And then when that money comes in, those expenses have been carried forward.
Right.
That's a good strategy.
Yeah.
Just came up with that.
Yeah.
Yeah.
Oh, yeah.
Travel, recruitment visits.
Yep.
Well, that's usually paid for. But if you're traveling to a school to check it out, travel deductible.
Yeah. Any of the
and see how much money they spend on their sport. See how much money the parents spend.
Right.
Now, can you pay your parents?
Yeah, I would imagine. Yeah, why not? If they're doing something actively,
I would imagine a lot
of
the parents manage the finances for the young athletes.
Right. So absolutely, if I'm an athlete making,
and the benefit of paying your parents is you get it deducted against the money you've received.
That's right. They would obviously then have to pay taxes on the portion that they are earning. But yeah.
But you're going to give money to your parents anyway. What's the first thing you do when you get rich? You buy your mom a house.
Yeah, that's true.
No, that's not necessarily deductible, but you give her money to buy a house.
Yeah. But then she'd have to pay tax on it. But she might be in a different tax bracket than you, and that would be a good tax strategy. you're shifting income.
That's right.
What the IRS is generally looking for is parents shifting income to their kids because their kids are in a lower tax bracket. They're probably not often looking at.
But that's a common strategy.
Yeah, that's right. Shifting income amongst people with different tax rates.
The student has become the teacher. The child has become the parent. And now the strategy is paying your parents.
Right. I think we've got this covered. What do you think?
I want to talk about your weekend.
That's got to be on another podcast, man. We can't.
I don't want to be on that podcast.
You don't want to be. Why not?
I mean, I have kids. Just kidding. That was unrelated.
We have a lot of editing in this episode.
It's going to be 3 minutes long.
No, we can leave some of it in. All right. Well, thanks for joining us for this week's edition of Two Accountants Talking Shit. I'm Gary.
I'm Mike.
And we will talk to you soon.
Okay.
Thank you.
Thank you.
And that's today's episode of Two Accountants Talking Shit.
If you're making money and still getting surprised by taxes,
you don't have a tax problem.
You've got a planning problem.
Don't forget to subscribe, follow, and send this to a friend. We'll see you next time.
Resonate.